So let's talk about the most controversial thing here, which is why there's 100% certainty, 100%
Yep.
of a housing crash. I heard you talk about this, and we talked a little bit about it for the podcast. I said, let's just wait. Let's talk about it on the podcast.
There is a 100% certainty of a housing crash. And one might be wondering, first of all, how could you say that? No one has complete clairvoyance to know the future. And the reason there's a 100% certainty of a housing crash in this era is because it already occurred. It happened in April of 2020, more than 3 years ago. It was a housing supply crash, not a price crash. The fact that we have had a supply crash really hedges against any sort of price crash. So using Freddie Mac data, and I shared the chart with you before I came over to the studio here so that you could see the backup. There are so many ways to go ahead and measure the available supply of homes, but about 1.5 million is what you'll see Fred, the Federal Reserve real estate data, rather Federal Reserve economic data. About 1.5 million has historically been the amount of available homes going back to 2016. It began to fall after that. With what happened in the health crisis, it plummeted in April of 2020 to 600,000 units, and it still hasn't rebounded, and it's continued to fall. So it's a 60% supply crash, 1.5 million down to less than 600,000 now, and that's what hedges against a price crash. That's why prices are continuing to stay buoyant. At whatever demand level, the supply is really low, and that helps keep a bid on property. And really, I'd like to share with you the profundity of the fact that we've had a supply crash, not a price crash. I mean, think about this. We're the most powerful nation in the world by so many measures. We're the most powerful nation as far as political positioning and our military and our currency and our brand. The most powerful nation in the world, and we have trouble housing our own people. I mean, we're talking about food, shelter, safety, Maslow's hierarchy of needs, base level stuff here. So it's actually a bigger deal than a price crash. If you think about it, you may very well see more homeless people in your hometown, for example. So the crash already occurred, a supply crash, not a price crash.
Yeah, it's an important distinction. And I think people really need to back up from this a little bit and understand where things are headed. You know, we have affordability problems. We definitely have homelessness issues creeping up. And so what really, really challenged everybody were these federal funds increases and interest rates that went up. So all of a sudden, you know, we've also had the largest delta between rents and the average mortgage price. So you got mortgages here. So rents and mortgages were kind of trending along at a pretty equal amount. But now, because of the home prices that went up and the interest rates went up, there's a big gap between rents, even though rents have gone up. So that's also keeping people in their houses because they've got the 6%, let's say 5-6% interest rates, but they bought them at 3%. So they have this trapped equity, right? So if you own a home that's $500,000 and you have 3% on it, you're not going to move. Right?
No, it's the mortgage interest rate lock-in effect. Yeah. And that's a really astute point, Ken, because this plays in to the national dearth of supply. I talked about 1.5 million available units down to 600,000. I talked to just lay people and everyday homeowners that have become landlords because they say, I don't want to sell my home at its 3.25% interest rate. So when I move out of it, I just want to hold on to that loan and rent it out. In the United States, you can't move your mortgage along with your property like that. So it's that interest rate lock-in effect. That property, rather than coming up for sale, which would increase supply, doesn't. It stays put. And almost 2/3 of mortgage borrowers in the United States have a mortgage rate of 4% or less.
That's a staggering number.
It is.
So I always tell people, Keith, you know, when I was growing up, cash was an asset and debt was a liability. But now it's the opposite. Cash is now a liability because inflation, if you have it in the bank, is running faster and harder than what you're getting in interest. And now that debt at 3%, let's say, is an asset. You would actually be selling the property and you'll be getting rid of that asset. You can't borrow at 3% today because that is OPM or other people's money like we talked about, right?
Right. And if I borrow from a bank, say I'm a borrower and I want to take a loan from you, well, of course, if I can do that at an interest rate that's less than the rate of inflation, I want to do that because it's profitable. And how the mechanics of that work actually is when I repay Ken, the bank in this case, every month, that dollar debases on him faster than his interest can accrue on me. That's profitable for you if you can find that. It's getting a little harder to find, but you can, in some situations, still get interest rates lower than inflation. And inflation is such a foofy number. We know that the CPI is manipulated with substitution and weighting and things, but if you can borrow at less than real inflation, that's exactly the transaction you're profiting from.
What do you think real inflation is? Because I'm all over the internet trying to figure this out, and I go to all the shadow stats and all the things.
Yeah, that's good that you're on shadow stats. There isn't really a good, accurate way to measure inflation. I mean, Ken and I, if we're next door neighbors, we're going to pay different rates of inflation. Say one of us is a vegetarian and the other eats meat, then inflation in the price of steak affects one of us but not the other. So if he commutes more than I do, gasoline prices affect him more than me. It's very difficult to pin down what the real rate of inflation is. There are hedonic reasons as well. Hedonic means pleasure seeking. So, for example, if home values go up 10% in a year, but now it's more common for homes to have quartz countertops in them a year later, and they didn't have that in the homes of yesteryear, how do you adjust inflation for that? Because you're getting a better standard of living with quartz countertops. So this is why Ken and anyone has such a hard time pinning it down to what's the real inflation number. It's really nebulous and slippery.
I do know it's more.
We do know it's more than what the CPI is reported.
I know.
How much more, no one knows.
I know, it's true. It's all over the map. But I got to tell you, man, things are creeping up. We were, my wife and I were, we just go to dinner and it's $100 now. I mean, there's all these things that are a lot more. But one thing is for sure, guys, if you can have an interest rate less than inflation, you're beating the market. That's the important thing to understand. And that's why, going way back to Rich Dad Poor Dad with Kiyosaki, he was way ahead of his time when he said cash is trash and, savers are losers. And he doesn't mean that you're a loser. What he means is savers are losing money as compared with inflation. Back then, it was, 2%. So now it's obviously more, right?
Yeah, and really with inflation, I think the word is noticeable. No one talked about it when it was about 2% these past few years, when it was right around the Fed target. It isn't until it became noticeable that it really became a thing. And, what do they say? What's the Walmart greeter say? They no longer say hello at the door. Instead, they just apologize for what's about to happen to you in there. It's noticeable.
I noticed I was digging into the CPI or the Consumer Price Index recently for a video I was doing. And I saw that housing was 44% of that number. Yeah,
between rent and owner's equivalent rent. Those two measures contribute to the CPI.
So that's a lot. So think about that, because I know, what does that mean? To me, that means that the Fed is not done increasing rates. Because, even I guess now they're reporting it at 5%. But if 44% of that 5% is housing, in theory, then it looks to me like they're gonna clip away at more of these federal funds rates, right? What do you think?
That's right. A lot of people think the Fed pivot will come later this year. The Fed pivot means when they stop hiking, which is increasing rates, and begin to lower rates. I've got something really almost pretty trippy, really, on interest rates to share with your audience here, Ken, because I think this is a real paradox that's going to blow some people away.
What is it?
So we know that mortgage interest rates have been up so much lately. And you know what happens with rising mortgage rates, right? When mortgage rates rise, home prices, you thought I was going to say fall, didn't you? No. When mortgage rates rise, expect home prices to rise. And you might say, what? That turns my whole world upside down. I mean, wouldn't one know? that when mortgage rates rise, well, that decreases affordability, so one would afford less and prices would need to come down. And the lens I like to look through a lot of times, Ken, when we talk about applying economics to real estate, it's what I call history over hunches. I think it's really easy to have a hunch that when mortgage rates rise, well, obviously prices would have to come down due to impeded affordability. So maybe you're still wondering, well, in what kind of upside down world would that happen? It's the world that you've been living in these past 2 years. What happened in 2021 and 2022? Home prices rose at a torrid pace, about 20% in 2021, and the following year, last year, another 10%, way beyond historic norms. And what happened with interest rates during that same time? They about doubled. I mean, they climbed a cliff. So that actually usually happens, that when rates rise, prices rise. In fact, in the history over hunches vein, Winston Churchill is the one that said, the further you look into the past, the further you can see into the future. So let's open this up and look at the past, talk about why this happens, and then think about some lessons that you can learn from it. So in about the last 30 years, since 1994, mortgage rates have increased substantially 9 times. That's defined as a mortgage rate increase of 1% or more. And during those 9 times that mortgage rates rose, home prices rose 7 of those 9 times. This typically happens. And when I share this with real estate people, Ken, a lot of them are blown away. They don't understand how they really don't even believe it. And I shared the data with you right before I came over here to the studio. And maybe you can even put that chart up there to show people that. But you know what? When I talk with doctors of economics, like ones that I interview on my show, some of them aren't aware of it, but they all say, oh yeah, I can believe it. I can understand how that would happen. All right, so what's going on here? Why does this happen? Why, when mortgage rates rise, would home prices rise? And, they're for a couple reasons. Ken, you and Danil talk so eloquently about lag effects in the economy.
Yep.
So that's one reason, but this can't completely be explained by lag effects, because we have to think about what makes a person buy a home, okay? We'll come back to that in a moment, but let's think about what happens when rates rise. Okay, generally, the Fed is saying that the economy's hot, people are employed. Right now, there are some high-profile tech layoffs for sure, but there are still more open job positions than there even are people to fill them. And this makes inflationary pressures heat up, so that's why they raise rates. Well, when everyone has a job and you have an option, if you get laid off, to go to a second job, and employers are competing for employees, what happens? You feel pretty secure in your job. And what do you do when you feel secure in your job? You're likely to buy a home. So your situation, your income, your job security is an even more important factor than what mortgage rates are. So this is why, completely counterintuitively and paradoxically, when mortgage rates rise, expect home prices to rise as well. And in fact, Ken, the only 2 times in the last 9 that rates rose that prices didn't rise as well, when they were 2007 and 2008, when there were really wacky aberrations going on in the market leading up to the global financial crisis. So again, when rates rise, prices typically do too, completely opposite of what most think.
Yeah, and don't forget that part of the reason rates rise is because of the scarcity. So when you go from 1.4 million to 600,000, you have less. Just basic demand and supply, less supply.
That's right. And I think importantly, one needs to remember that there's less supply of both homes to buy and homes to rent. And even when one does want to buy and they continue to get shut out of the market with higher rates and higher prices, that obviously puts more people back in the renter pool, which is pretty good for guys like you and I, Ken, that own a lot of income property.
That's right. That's why I did that video, Renter Nation, because it's not good, by the way. This, housing is supposed to be balanced. So as somebody who owns a lot of rentals, we lose people to single-family home buying. That is the way it's supposed to be, right? And then there's some people that, when they're done with the single family side, they want to come to rentals for convenience, for flexibility, for all kinds of things. So it's a natural step. And so when one's out of whack or the other's out of whack, it's not necessarily good.
No, it's not good. I mean, that impedes the upward mobility and really part of the American dream. Of course, you never want to lose a tenant from one of your apartments, but at least you can say, hey, congratulations, you moved up a rung or whatever. So Just the cost of any entry-level housing is really high. And in fact, when you parse the amount of available homes by the entry-level type of, say, single-family homes and duplexes, which tend to be the ones that make the best rentals, they're even more scarce.
Yeah, it's gotten worse. I don't know that as a builder, as you know, we can't build entry level.
Most can't make it feasible.
The cost to build a house today is expensive.
Yeah, it really is. And, if you are looking to be a real estate investor in the 1 to 4 unit space, which is really an area where I specialize, if you can find a builder that builds entry-level homes, I do know of a number of them in the Midwest and South. This could be a time for you to get a new build rental property more so than a renovated one. That's really opposite of 10 years ago. 10 years ago, we were still coming off the global financial crisis. Remember how crazy that was?
Yeah.
When the cost of property was even less than the replacement cost, no one was going to build. Now you do have people building, and, Ken, I know a number of these builders, because mortgage rates are higher, that they're helping the investor, the individual investor.
Buy down the rate.
People like me, they're buying down the rate. So it's quite common for, say on a $350,000 property, for the builder to give you 2% of that $350K purchase price. What is that? $7,000 at the closing table for you to buy down your mortgage rate. You also have turnkey new build companies that are giving 1 to 2 years of free property management. So new build typically costs more than renovated, which is why in the past a lot of investors like to buy a renovated property. But with the new builds and incentives like that, and the fact that you're probably going to have lower insurance rates with new builds versus renovateds, I think this really tilts toward you as the investor that's looking to add property to your portfolio. It makes more sense now to look at new build than it has at any time in the recent past.
Yeah, I know that, like, when we look at those big projects for acquisition, we're looking at what is the cost per unit for, let's say, an acquisition in Phoenix versus building one. And in the last 3 years, it was building all day long because the cost was $100,000 more per unit to buy. Crazy how existing product can get pushed up that high. And so all of a sudden, that makes the building more affordable. Yeah, actually. And when you build the one next to the other, people are going to want the newer product all day long.
Yeah, Ken, and maybe I can ask you a little something, being a builder. I have learned from some builders that, in a way, some things are nice because they're not getting as much competition from resales on the market. We talked about why there aren't resales on the market. People want to hold on to their low mortgage rates. So builders don't have the competition that way. But maybe you could let me know. Of course, it's going to vary by region, and we've been talking very much nationally so far in the conversation here. But really, what's the lowest price point at where it's still feasible as a builder to build, where you have enough margin? Like, what's the lowest price point on maybe a single-family home and then something larger?
Yeah, so for me, it's mostly just apartments. So, we'll go into a market. I'll give you a great example. We can buy in Austin, Texas, mid-90s product, vaulted ceilings, 9-foot ceilings, beautiful garages for $180,000 a door. Really nice. There's no way we can build that there for that price. Not even close. However, you take that exact project and you move it to Phoenix, it's $350,000. Now, the rents are different, the expenses are different, the insurance is different, the property taxes are different. I understand the math isn't the same. But on a per foot basis, on a per unit basis, that's how different it is. So, because of that, we're building in Arizona and buying in Texas. So now that can change. Also, that Austin can get really hot, those prices can go up, and then it would change that dynamic. And so, to your point, you always have to take a look at the difference between the deliverable. Do you buy? The one thing I do like about buying is that it's immediate. You could step into something immediate, make change immediate, whereas there's a big lag with construction. So you do have some interest rate risk because you can't get a fixed rate loan on something that doesn't exist. It's land, it's air, and then it's built until it's in service, they call it. Then you can put fixed debt on it, but that's it. Up to that point, you're subject to a little bit of the whim of the fluctuations of the Fed and all the other things that determine interest rates. So you do have those things. So they're a little, but we do love the new properties, and so do our tenants. So when you build something new, people want to be there. And they move out of that 10-year or 15-year-old product into something new. So there is that. Plus, you get a little bit more rent, and all of those things. So there's positives and negatives for both.
Yeah, so it's really, I'd say in the last 10 years when you've seen the advent and proliferation of these build-to-rent companies. They're turnkey companies that build a finished product for you. That's the first thing that they do. And then the second thing they do is they place a tenant in it for you. And then thirdly, they hold it under management for you, the investor, if you so choose. Basically, it's those three things that define what a turnkey rental property is. So it's making more and more sense to do that with new build properties.
Yeah.